Entering the crypto arena, spot versus futures. The world of cryptocurrency trading can feel like a vast and complex landscape. It's important to understand the terrain before you begin your journey. Two fundamental approaches to trading cryptocurrencies are spot trading and futures trading. Each offers distinct advantages and disadvantages. Understanding these differences is crucial for making informed trading decisions. It helps manage risk and maximize potential returns. Let's delve into the world of spot and futures trading. This guide will provide a clear and concise explanation of both approaches. We will explore their key features, pros and cons. Whether you're a newcomer to the crypto space or a seasoned trader, this guide will equip you with the knowledge to choose the trading method that aligns with your goals and risk tolerance. Spot trading, the basics. Spot trading is the most straightforward form of cryptocurrency trading. It involves buying or selling a cryptocurrency at its current market price, known as the spot price. When you engage in spot trading, you take ownership of the asset. Think of it like buying groceries. You pay for the goods and they're yours to take home. One of the main advantages of spot trading is its simplicity. It's easy to understand, making it an ideal starting point for beginners. You buy Bitcoin, Ethereum, or any other cryptocurrency and hold it in your digital wallet. You can hold on to it for the long term, hoping for its value to increase. Spot trading also carries less risk compared to futures trading. You're not exposed to leverage, which can amplify both profits and losses. While this limits your potential gains, it also safeguards your investment from substantial losses. However, spot trading does have its limitations. Without leverage, you'll need significant capital to make substantial profits. Additionally, you can only profit when the price of your asset goes up, limiting your trading strategies. Futures trading, a deeper dive. Futures trading is a more complex beast. It involves trading contracts that speculate on the future price of a cryptocurrency. Instead of owning the actual asset, you're essentially betting on its price movement. Imagine agreeing to buy a certain amount of coffee beans at a predetermined price in 3 months. If the market price of coffee beans rises above the agreed-upon price, you profit. If it falls, you incur a loss. One of the main attractions of futures trading is the potential for significant profits. This is largely due to leverage, which allows you to control a large position with a smaller amount of capital. For instance, with 10 times leverage, you can control $10,000 worth of a cryptocurrency with just $1,000. This can amplify your gains, but it also magnifies your losses. While leverage can be a powerful tool, it's a double-edged sword. The inherent risk in futures trading is substantially higher than in spot trading. Even small price fluctuations can lead to significant losses, especially with high leverage. This makes futures trading unsuitable for beginners and those with a low-risk appetite. Section 4, Spot versus Futures, a side-by-side comparison. To understand the key differences between spot and futures trading, let's look at a side-by-side comparison. Feature, asset ownership. Spot trading, you own the asset. Futures trading, you own a contract speculating on the asset's price. Feature leverage. Spot trading, not available. Futures trading available. Feature risk. Spot trading, lower. Futures trading, higher. Feature shorting. Spot trading, not directly available. Futures trading available. Feature fees. Spot trading, generally lower. Futures trading can be higher due to overnight funding rates. This table highlights the contrasting characteristics of spot and futures trading. Spot trading offers simplicity and lower risk, making it suitable for beginners and long-term holders. Futures trading, however, provides the potential for higher returns through leverage but comes with increased risk. Section 5. Choosing your trading path. Choosing between spot and futures trading depends on your financial goals, risk tolerance, and trading experience. Ask yourself these questions. For beginners, am I comfortable with the idea of owning cryptocurrencies directly? If yes, spot trading might be a good starting point. How much risk am I willing to take? If you're risk-averse, spot trading is generally safer. Am I looking to make quick profits or hold for the long term? Spot trading is more suitable for long-term holding. For advanced traders, do I want to leverage my capital for potentially higher returns? Futures trading offers leverage. Am I comfortable with the high-risk, high-reward nature of futures trading? If you understand and can manage the risk, futures trading might be suitable. Do I want to profit from both rising and falling markets? Futures trading allows you to short the market, profiting from price declines. Choosing the right trading method is a personal decision. There's no one-size-fits-all answer. Understanding the differences and carefully considering your circumstances is key. Section 6. Navigating the crypto waters, final tips. Regardless of your chosen trading method, some universal tips can help you navigate the crypto waters safely and effectively. Start small and learn. Begin with a small amount of capital that you can afford to lose. Focus on learning the ropes and understanding the market before making significant investments. Manage your risk. Implement risk management strategies like stop-loss orders to limit potential losses. Don't invest more than you can afford to lose. Control leverage. Leverage can amplify both profits and losses. Use it cautiously and start with lower leverage ratios. Stay informed. The cryptocurrency market is highly volatile and constantly evolving. Stay updated on market trends, news, and regulations. Remember, trading cryptocurrencies involves inherent risk. Never invest blindly or based solely on hype. Do your own research, understand the risks, and trade responsibly. Section 7. Conclusion. Finding your footing in the crypto world. Understanding the distinction between spot and futures trading is paramount for anyone venturing into the cryptocurrency market. Spot trading offers a simple and less risky way to own and trade cryptocurrencies, while futures trading provides the potential for higher returns through leverage but comes with increased risk. By carefully considering your financial goals, risk tolerance, and trading experience, you can choose the method that aligns with your needs. Remember to start small, manage your risk, and stay informed to navigate the exciting world of cryptocurrency trading successfully.